quantum of borrowing. One of the reasons there is very tight liquidity in the banking system currently is that the government cash balance with the RBI is at a significantly elevated level. And some of this is possibly because the government is likely to meet its absolute fiscal deficit target, but it is maintaining its borrowing targets. But the inflows through small saving schemes have been nearly 1.5 lakh crores higher than what was budgeted. So the government may end up this year with maybe 1.5-2 trillion rupees extra in terms of money, cash in hand. And therefore, the next year's borrowing would actually be much lower than what we had this year. So these are the three major points. There could be a corollary or a sub-point to the second one, which is what happens to quality of expenditure? Will the government continue to expand its Capex? Does it have space to expand its Capex? In our view, I think the growth in Capex may actually slow down, but there should still be some room, given that subsidies will fall again and some of the basic expenditure like salaries and pensions don't grow as fast as nominal GDP.
Neelkanth, this time obviously there wouldn't be any economic survey, but the FinMin review report, which was released yesterday, is calling FY25 GDP growth closer to 7%. Now, this is the second time we are hearing this number. First time, of course, when RBI governor himself upped the GDP estimate after the policy meet. It appears that 7% is where the government machinery, all the key agencies are aiming or attempting the growth to pan out. How confident are you? You have recently upped your growth estimate as well. How are you seeing the elements which contribute to that kind of number?
Yeah, so no, we've been quite constructive on India's GDP momentum. In fact, we didn't really up our estimates. We've always had a high estimate, and we just said that the trend growth assumptions for consensus will keep getting bumped up. So consensus has been quite conservative. In fact, in January last year, some forecasters were talking about 4.8% GDP growth in FY24 because they thought that the economy had slowed down pre-COVID, and then the COVID scarring would slow it down further. Whereas our view was that COVID scarring won't be that intense. And so I think 7% is quite realistic, quite achievable. That is, if there are no global accidents and financial accidents, which is what I think the chief economic advisor has also commented on. Now, if 7% growth is real and real growth is delivered, I think nominal GDP growth then can actually be 11% plus. So given that we are apprehensive about the global financial conditions, we are running with a 6.5% growth in FY25, and therefore our nominal GDP growth assumptions or what we think the government will come up with is 10.5. If they take 7 plus 4, maybe there is another 50 basis points, possibly another 100 basis points of nominal GDP growth, in which case the assumptions on taxes and on the scope for spending can be slightly higher.
Neelkanth, what are your thoughts on Capex? Over the last few years, we've been seeing that government's contribution to Capex has been rising, and in fact, it has been spearheading overall Capex in the country, even at a time when private Capex was soft. Now, early signs that it's also picking up. Do you think you'll have that shades and a clear stamp of that this budget as well? And do they have room for further upping it?
Correct. So both of those are important variables as the government thinks about what to spend on and whether to spend. And the first is that I think there is a very clear sign that like profits of industrial companies are rising at 20-25% CAGR for several years going forward, and which suggests that at least some kind of private corporate Capex has started coming back. I don't think it has come back fully yet, and therefore some support is needed. Some point to that is that if you try to consolidate too fast and you're not very careful about it, your debt to GDP consolidation, remember that the primary objective of the government is and should be to bring down the debt to GDP to much more sustainable levels, meaning that 80% plus is not healthy. It needs to be at least 70, if not 60, which is what the FRBM review committee had suggested. For that to happen, you need to keep the GDP growing. So if you consolidate too fast, And if you consolidate poorly, your nominal GDP growth slows down, and in which case the debt to GDP does not come down as much as expected. So the government needs to keep doing Capex. The quality of expenditure needs to be kept high, even as the top line spending is being controlled. So it is very important that the government continues to spend on Capex. Is there scope for a lot of Capex? I think on national highways, the pace of construction perhaps does not need to rise meaningfully from here. So we are at already about 15,000 kilometers. I think 20,000 would be pretty much the max, because if you have 2 lakh highways and you repair them or rebuild them once every 10 years, I don't think the run rate can be meaningfully higher than where we are already. But I think in railways there is significant scope for further expansion. I think on the side, BSNL's expansion may need some more money as well. But about a 15% increase is what we think the government can afford to have. There is some, scope for savings because fertilizer prices are lower, so subsidy bill can fall off. It should fall off in FY25 as well. But given that there are other expenses that also need to be incurred, I'm not sure that stronger than that is possible. Remember that if you compare the fiscal numbers as a percentage of GDP versus what used to happen pre-COVID, the Capex numbers are already 1.8% of GDP higher than what we were pre-COVID. And remember that interest expenses are, because of the borrowing that happened during the pandemic, are already 0.5% of GDP higher than what we had pre-COVID. So the scope for the government to expand it meaningfully from here is somewhat limited.
Neelkanth, what are your thoughts on this matter of tight liquidity? We understand that many of the big lenders we speak to are also kind of complaining that it is making operating environment tougher. At the same time, we all know that liquidity is being put on leash so that inflation, which has been sticky, doesn't start rearing its head again. How long do you think it will take this equation to even out or come into complete control?
Okay, so I'll make 3 points there. It's a very important question. The first is that the tight liquidity stance is a deliberate one. And if you think about money in the deposit system, there are only 4 moving parts. The first is how much money is RBI injecting. Second is how much is bank credit growth, because as you know, when banks lend, they create money. The third is money being withdrawn at an accelerated pace and is currency in circulation. So, when you take money out of ATMs, the circulation becomes parallel, it goes out of the deposit system. And the fourth is cash balance of the government, because the government collects taxes and is not spending fast enough, or borrows from the market and is not spending fast enough. It sits in a separate account with the RBI. It does not really become part of the deposit system. So these are the only 4 moving parts in the deposit system. And if your credit growth is strong, if your currency and circulation growth is not strong, which means that not too much of money is going out of the deposit system, then there are only 2 variables, right? So first is how much money is RBI injecting, and second is what is the government's cash balance. Now, on the first point, over the last 18 months, I think the RBI has injected nearly zero money. So this is what I've called for the last 7-8 months India's quantitative tightening, that the RBI is deliberately keeping conditions tighter. It has meant that the marginal overnight rate has shifted from the repo to the MSF, so there's a 25 basis hike. So this is intentional. The second part is, will the RBI be forced to change its stance? Remember that headline inflation is still high. I think global uncertainty because of excessive borrowing by the US government, and then dollar because the Federal Reserve is still doing quantitative tightening. So you need to be a bit careful. And so that factor is also still there. And the third is growth, as you also mentioned, is actually surprising on the upside, surprising the RBI on the upside. If your growth forecasts are going up, there's no reason to really change your liquidity stance. So the third point and which is the most important one, is that currently, given excessive cash balances of the government, and which you can imagine is not a permanent situation, this is not by any means deliberate, eventually will ease. Either the government, which has collected the taxes or borrowed from the market, will spend that money, or in case it's struggling to spend that money, it will cancel auctions, in which case the liquidity kind of comes back into the banking system. So I think some amount of tightness is deliberate, but I think what the current situation, which is been exacerbated by significantly higher government cash balances, and that I think should be temporary. It's much easier to control and does not really require a policy shift.
The other thing I wanted to talk to you about, Neelkanth, is that in continuation with this budget and a lot of reform work which is happening outside the budget as well, going into the election year, we have one of the things when we speak to institutional investors across the world, everybody lauds the current leadership's focus on reforms and pulling India's growth ahead on the back of those structural reforms. Now that we are heading into elections, people are wondering and kind of trying to analyze where else is the scope for reforms. There's a lot of reform work already happening. Which are those areas where you see scope for further work, if they've already started, or commentary from the government, if I may call a guidance from the management, that probably in the coming years, that is where the area of focus would be on the reform front? Something which you have analyzed?
See, here one has to be prescriptive and not predictive, because clearly the government will have its own priorities. What one can do sitting outside the government is prescribed, meaning that what are the areas which require work and therefore should be the government's priority. There are many such areas, right? Remember that we are still a lower middle income economy, so there are many warts in the system that we need to clear up. More important is taxation. So I think our personal income tax to GDP is improving, but it is well below where it needs to be. On taxation in general, the pace at which you sign advanced pricing agreements, and that's very important, giving tax certainty to foreign firms which are coming to India, or which should be coming to India, and bringing their global value chain linkages and FDI. So those, we need to sort of move faster on that, clear those things up. I think we need to radically transform our urban administration. I think the cities are going to be a very important vehicle of growth. We have, thankfully, at least in our national consciousness, moved from looking at Delhi for all changes to actually looking at state governments which can control land, labor, environment, and every other thing, which affects the business on a day-to-day basis. I think that granularity has to go down to the district level. I think the states need to devolve authority, even maybe some fiscal powers to district administrations, because our districts themselves are actually very large. We need to do, I think, significant changes on the education front, on the healthcare front. Remember that when India as an independent nation turns 100, the people who are going to be in their prime working age are children now. So making sure that they are well fed, they have good brains and good bodies, and also that education that they get, the skilling that they get. I think all of them are very important developments. We also need to start preparing India to becoming a product nation, becoming owners of intellectual property, creators of intellectual property. Remember that if you have to prevent getting stuck in what is called the middle income trap, you need to create frameworks which encourage R&D to happen. When you are moving from low income to middle income, there is what is called, you're sort of using foreign technology. The diffusion of foreign best practices and technologies happens. Like think about telecom in India. So that takes you to a certain level. But from there to becoming rich country, you need to have very different frameworks, because you'll have to experiment with different technologies. You cannot rely on time-tested, cheap technologies to come in from abroad. And so those frameworks, I think as a nation, we need to start evolving. We need to do a lot of pre-commercial R&D. The government needs to be involved in that. We need to do changes in how we regulate ourselves. Because if the regulator is not supportive, how can innovation happen? So there are many such changes that I think will be necessary, but these are all prescriptions. I wouldn't call them predictions.
Sure. Neelkanth, where do you stand on this argument that the case, in a base case format, the case is looking very strong for next 5 to 7 years of growth, which could be in the range of 6 to 7%, lower end 6%, maybe higher end, our ambition is 7%. But worst case, it may not go below 6. So the band could be 6 to 7. Do you think it's possible 5 to 7% prolonged growth? Do you have the visibility?
Absolutely. So I've been saying for a while now. In fact, even when the recovery itself was uncertain, I've held the view that we are so starting late 2021, where we put out a note that the real estate cycle was starting to turn, and that peak dwelling construction was the reason that India's GDP growth was almost 1% point below where it should have been in the years before COVID.
अरे भेज दिया डैड ने